Before we get started, I'm Uncle Dan. My family and friends have come to me for the last 35 years asking for help, asking for answers on what to do in these markets. So I've decided to set up this channel and see if there are other people who could benefit from these discussions I'm having with various people. So today we're going to be talking about warrant. A question was raised yesterday about the Tortoise warrant and its deviation from its implied value based upon where the shares are trading. And how could you exploit that? So today we're going to talk about that. How can you take advantage of these cheap warrants? I'm going to walk you through the basics, and then we'll talk about a strategy you can use if you want to try to do something in there. Why would you buy the stock if you can buy the warrant for only $8, right? So this is the stock. Let's look at the warrant. Okay, as you can see with the warrant, before the deal was announced, it had already creeped up to above $1. What you can see is the warrant went from around $1 to $13.85, and it's now trading. Oh, it's trading at 7 now. Oh, it went all the way down to almost 6 today. So you can see that after the stock peaked at 34, convertible at 11.50, coming straight down with the stock. They're obviously highly correlated. The warrant converts into the stock, but how does that work exactly? So let's go through what a warrant is in relation to Hyliion and Tortoise Acquisition. Now, the warrant is a contract with the right to buy one share of stock at a predetermined price. The warrant has a strike price. This is agreed up front. This is the price that you'll be converting it to. And in this case, the strike price is $11.50 when the stock is 24. So it's significantly higher than the strike price. This is the Tortoise Hyliion deal. Okay. Now there's an expiry date and a redemption date. You might as well just focus on the redemption date, because 30 days after the deal's done, they'll probably file an S1 and you'll have 30 days to redeem your warrants for the stock at $11.50. And right now that warrant's trading somewhere between $7 and $8. So the question raised this morning in the comments was, why not just buy the warrant instead of the shares? Well, if you buy the shares at 24, you're going to be paying $24. And if you buy the warrant, you're going to be paying $8. So it's a third of the price. So that's a good question to ask. Like, why wouldn't everyone just buy the warrant? And then, first of all, if you did buy it, could you sell it? And yes, you can. It does trade, like we just saw on the screen. It trades just like the stock does. So yeah, you could buy it and then sell it if it went up, right? So that's one option. And then, of course, the buyer of the warrant has to decide to redeem the share after that S1 is deemed effective from the SEC, which is probably going to be mid-July, which means you'll need to redeem those shares at $11.50, okay? And so what does the risk profile look like on this warrant relative to the stock, right? So if we look here, basically, the stock's currently trading at, say, 24, okay? The warrant is trading at 8. So basically your break even is at $19.50. If you redeem the warrant for shares, and if the shares are trading above $19.50, you'll make a profit. In fact, if the stock goes up to, say, 34, you'll make $14.50 profit. So as you can see, there's limited loss to what you pay for the warrant of $8. So it does seem kind of odd that you wouldn't just buy the warrant. But here's the issue. You got to call your broker to redeem the warrants, and you got to wait 2 to 3 weeks before you actually get the shares. So you are stuck in there for 2 to 3 weeks waiting to get the shares if you want to sell. So if you can imagine, if everyone did that, you've got to believe the stock is going to be under pressure, okay? Because as soon as they get their warrants redeemed for shares, they're probably going to want to sell them if that's why they got into it, right? It just makes sense, right? If you've got a cheap warrant, you buy it, you get the shares, you sell them for a profit. So how can you hedge the risk of waiting for the redemption of the shares? And really the only way to do that is either short shares in the market, which are difficult to borrow, or you've got to go look at the puts. Not surprisingly, the puts are not cheap. It's almost as though people know that the warrant holders are going to be in here buying the puts. So, but that's what you've got. You could either try to short shares, and if there are none to borrow, you might be in trouble. Your broker might try to force you to buy them back. right? So there's risk around borrowing shares, and I don't recommend it myself. I don't borrow shares. So the only other way to do it is to buy a put, and these puts are not cheap. So that's the challenge. So that's the only way to do that. So I hope that helped. The Tortoise Acquisition /U, if you notice, the price is close to the price of the stock and the warrant, okay? And the reason being is that when this prospectus was raised and uploaded to the SEC website, what they did is they said each unit holder who applies for their IPO will be entitled to 1 share of stock and 1/2 warrant. So what's happened is they've made all 3 of them tradable in the market. So there are people who went in and they bought the units at $10, and those units that they bought at 10 are trading at 27. So that's a phenomenal return for those who went in. Now you could go to your broker and you could split them up. If you split them up, you get 1 share of stock, which is trading around 24, and you're getting 1/2 of a warrant. So if the warrant is trading at 710 as an example, then you would be getting half of that, which would be 355. So you add the 355 onto the 24 and you get 2755. So that's what the 2 pieces split up would equal. If there's any questions, leave them down below and I'll be happy to answer them.